Hey everyone, and welcome to The Explainer. Today, we are unpacking a really fascinating, high-stakes situation surrounding one of the most talked-about enterprise software companies in the world right now, ServiceNow. We're looking at a textbook paradox here, a massive tug-of-war between some genuinely incredible business momentum on one side and some pretty serious valuation anxiety on the other. If you've been keeping tabs on the enterprise software space, you already know that ServiceNow is at an absolutely pivotal moment.
Okay, let's just dive right into this because look at this massive discrepancy. On one hand, you've got a stock that has been absolutely on fire, rallying 29% in just the last month alone. But then you pan out a bit, and you realize that despite that massive surge, the stock is still down about 37% year to date. I mean, that is a wild swing in sentiment, right? It tells us the market is deeply conflicted about what this company is actually worth right now. Which brings us to the million-dollar question we're tackling today. Is this recent 29% surge a genuine recovery worth riding into the future, or are we just looking at a dead cat bounce waiting to disappoint anyone who buys in at the top? In the world of enterprise AI, this is the ultimate show-me story, and honestly, the market is demanding proof.
So, to figure that out, here's our game plan for today. First, we'll cover the bull case and all this AI momentum. Second, the bear case and whether it's priced for perfection. Third, 5 critical catalysts you need to watch. And finally, the final verdict. Let's get right into it.
All right, Section 1, the bull case and the massive AI momentum pushing it forward.
Look, the optimism behind this bull case, it's not just hype. It's driven by real traction in the numbers. Just check out this milestone. ServiceNow just crossed $1 billion, yet with a B, in AI annual contract value, or ACV, in Q2. That is a massive achievement. To put that into perspective, management actually set a target of $1.5 billion in AI ACV by year-end 2026. So after hitting this $1 billion mark with more than 40% sequential acceleration, that 2026 target suddenly looks incredibly credible, rather than just some aspirational pipe dream. The demand is clearly there.
And this brilliantly illustrates that we aren't just talking about tiny little pilot programs either. These are massive, real-world deployments. The U.S. Air Force is actively expanding its AI deployment with them. Experian is automating intelligence at scale. The city of Raleigh literally deployed a Level 1 AI specialist right out of the box, with absolutely zero in-house AI engineering team required. That's a game changer. And get this, a major airline is currently running 5 million annual voice calls on ServiceNow's voice AI agents in production, seeing results that management is calling straight up off the charts.
So, why are all these massive entities choosing ServiceNow? Well, it really comes down to this super clever concept, the AI control tower. Think about it. As AI agents spread like wildfire across different departments in a company, it can turn into the Wild West pretty quickly. You have different AIs doing different things with zero central oversight. ServiceNow swoops in and provides a unified platform to manage, secure, and observe all of this activity. Like one major food and beverage company recently discovered rogue AI agents operating across 5 different platforms with absolutely no governance. Their CTO had to step in, mandate that nothing goes live without risk compliance, and brought in ServiceNow's AI control tower. Solve the problem immediately. This is exactly how they are driving a wedge into the enterprise.
Now you might be wondering, how do they actually make money off this without hurting their existing business? Because Wall Street has had this lingering fear, right? If AI agents do the work of humans, won't companies just buy fewer user licenses or seats and basically kill software revenues? Well, check this out. 50% of ServiceNow's net new business is now non-seat based. They are successfully shifting to a consumption model. This directly addresses and really diffuses the market's fear of AI cannibalization. Customers are just paying for the AI they consume, not just the physical seats they fill. When you stack all this adoption together, the future growth potential is just staggering. We see Q2 total revenue sitting pretty at nearly $4 billion, up 24% year over year. We see that highly credible 2026 AI target of $1.5 billion. But look at the difference when we look ahead to 2030. Management is targeting $32 billion in total revenue. That's roughly double their expectations for 2026. This massive growth trajectory is exactly why analyst consensus remains a strong buy, with some price targets reaching as high as $248. But it's not all sunshine and rainbows. Let's move to Section 2, the bear case, or what I like to call pricey perfection.
Now, what's really interesting here is the sheer premium you have to pay just to get in on this action. Yes, technically the stock is trading at a discount to its own historical multiples, but a trailing price-to-earnings ratio of 80x? Objectively, that is steep. A forward PE of 31x is definitely better, but it still assumes flawless execution going forward. With a $131 billion market cap, this stock is literally priced for perfection. Any slight misstep, and you better believe the market will punish it.
And as we all know, perfection is incredibly hard to maintain in the real world. Let's systematically walk through the 6 sobering realities keeping the bears awake at night. First, execution risks are very real. Look at Q1. Regional conflict in the Middle East actually delayed large on-premise deals, causing a revenue headwind. Second, competitive pressure. Microsoft and Salesforce are aggressive, they're well-funded, and they aren't going anywhere. Third, despite that consumption pivot we talked about, Wall Street still harbors that lingering fear of AI disruption eating into user licenses. Fourth, margin pressure is mounting from the high costs of hyperscaler partnerships and AI integration. Fifth, we actually seen some insider selling following this recent 29% run. And finally, the earnings picture is just a little messy. Q2 GAAP EPS actually declined year-over-year to 90 cents due to acquisition charges and revenue mix shifts. So you combine all these factors and it totally makes sense why the stock currently holds a Zacks rank number 3, which is a hold.
So, what's going to tip the scales? That brings us to Section 3, 5 catalysts to watch.
Let's see how this builds into a roadmap for us. Step 1, and this is absolutely crucial, Q3 earnings on October 28th. The market absolutely needs to see if this AI demand is actually translating into sustainable profit growth, which means we need to see an EPS and margin recovery. Step 2, we need to see them maintain the pace to hit that $1.5 billion AI ACV target. Step 3 is margin recovery. Management guided to an 81% gross margin for FY 2026, and investors are demanding stabilization there. Step 4, we need to see successful cross-selling from their recent security acquisitions, Armis and Veza. And Step 5, the macro environment itself. Software stocks are a risk-on play, heavily influenced by Fed policy and the overall appetite for enterprise spending.
All right, let's bring it all home with Section 4, the final verdict.
So, what does this all mean for you? Well, how you act on this information entirely depends on your timeline. Here is the tailored takeaway. For long-term investors, the fundamentals really are strengthening. AI momentum is a reality here, not a fad. If you believe they'll hit that $32 billion revenue target by 2030, this is a high-conviction growth play currently trading below its historical multiples. But for short-term traders, the setup is incredibly tricky. That recent 29% rally puts the stock right near technical resistance. The next 10 to 15% move hinges entirely on that October 28th earnings call. If they beat expectations and raise guidance, we could see a push toward the $140 to $150 targets. But if they miss or offer weak guidance, multiple compression is going to kick in hard, and this stock could easily crash back down to the $110 to $115 range.
Ultimately, it all boils down to that one date. Can ServiceNow prove to the market that their massive AI hype is actually profitable on October 28th? Or will the sheer weight of their premium valuation and multiple compression drag them right back down? This is the ultimate show-me story in enterprise software right now. Keep your eyes glued to those margins, watch the tape, and position yourselves accordingly. Thanks so much for joining me for this explainer, and keep learning.